Most full-time creators run everything through one bank account. AdSense hits it, rent leaves it, a brand deal lands, equipment gets charged, Patreon pays out, coffee goes on the card. Every transaction, business and personal, moves through the same pool of money. Nobody has ever separated them. That's called commingling, and it's costing more than most creators realize. The problems show up in 4 specific places: your tax return, your financial clarity, your audit exposure, and your ability to access financing. None of them are hypothetical. Each one has a dollar cost attached. Start with taxes. Your accountant comes in at year end and does 12 months of forensic archaeology. Which charges were business? Which were personal? That reconstruction takes time. It costs more than it should. More importantly, it creates errors, not intentional ones, just the natural result of rebuilding context after the fact. Deductions get missed. Expenses that should appear on Schedule C disappear into the personal noise. At $300K gross, missing even 5% of legitimate deductions is real tax owed. Self-employment tax alone runs 15.3%. Federal brackets at that income level sit at 32 to 35%. Every missed deduction gets taxed at the full combined rate. Now look at financial clarity. Can you open your account right now and see exactly what your business earned last month? Most creators can't. The personal and business numbers are fused. You can't calculate your real monthly income without clean business revenue. You can't tell whether a tight month was a business timing issue or a personal spending spike. YouTube paid $4,200. Twitch paid $1,800. A brand deal hit for $12,000. Is that visible as business income? Or is it mixed with rent, groceries, and the Adobe subscription? There's no clean line. Most creators manage this by checking the balance and guessing. That's not a financial system. That's intuition at scale. Third, audit exposure. The IRS expects business and personal funds to be separate. When they aren't, it signals you may not be operating a legitimate business. More practically, if you're ever audited, the burden of proof falls on you. Every commingled transaction becomes something you have to explain and document. That's a $12,000 brand deal, a $3,000 equipment purchase, and 200 smaller charges, all requiring context you may not have. Clean separation makes an audit manageable. Commingling makes it expensive. There's a quieter version of this that hits before any audit. The home office deduction requires exclusive and regular business use. Picture 3 years in a dedicated studio, filming, editing, running the business. Every receipt running through one mixed account. The deduction is real, but the paper trail doesn't cleanly support it. That's a deduction you legitimately earned that doesn't survive scrutiny. The simplified method alone is worth up to $1,500 a year. The actual expense method, for a larger studio, often goes significantly higher. Fourth, and the one most creators miss until it's too late, is financing. A lender looking at your business credit application wants business bank statements, not personal ones. If your $300K flows through a personal account, lenders see no documented business income. You've earned it. You can't prove it in the form that matters. That blocks a business line of credit, a lease, or any revenue-based financing you'd otherwise qualify for. The fix is a 30-minute task. No accountant required. Most creators have simply never done it. Open a dedicated business checking account. Every dollar of business income goes in. AdSense, Twitch, Patreon, brand deals, merch, affiliate, all of it. Every business expense comes out of that account. Editor invoices, software subscriptions, equipment, all of it from the business account. At month end, transfer a fixed salary to your personal account. That one transfer is the only connection between the two. The salary amount is your call. It should reflect what you actually need to live on, not whatever's left after expenses. The immediate results are concrete. Your P&L is readable without forensic work. Your deductions are clean and defensible. Your business shows up as a real entity on a bank statement. A lender can see 12 months of business deposits and actually make a credit decision. You can see, month by month, whether the business is growing, flat, or quietly contracting. You can see whether reinvestment is creeping up as revenue grows. That's the ratio that determines your real take-home. On institutions, the same bank for personal and business is fine. The separation is what matters, not the logo. Some creator-focused financial platforms now offer business accounts built for irregular, multi-platform income. Worth a look when you're setting up the structure. This is general education. Your specific setup depends on your entity structure and state. A bookkeeper or CPA who works with creators can separate your accounts properly. They can also build a clean categorization system that makes every future tax return faster and more defensible. If everything is still in one account, the most important financial infrastructure move you can make is also the simplest. Separate the accounts. Do it before the next deposit lands.